Welcome back, everybody, to another deep dive. This time we're going to be looking at the psychology of money part 2. Have you ever wondered why people make just crazy decisions with their money?
Yeah. We think about financial decisions as these things that should be really rational, like logic numbers, but
You would think so.
the truth is our experience with money really shapes how we think about it a lot more than we realize.
Yeah, it's almost like we have these invisible scripts that are running in the background based on our own personal financial past. And the author kicks off with this line that I love. He says, "People do some crazy things with money, but no one is crazy." And I think it's so true because it's so easy for us to look at other people's decisions and judge them. But everyone's coming at it from a totally different place.
Absolutely. Our upbringing, the economy that we grew up in, and even just luck plays such a big role in how we see money.
Yeah. Okay, so to illustrate this, imagine someone who was born in 1950. They saw a pretty stagnant stock market during their key developmental years.
Right.
Now compare that to someone who was born in 1970. They saw a booming market. Those two people are going to have completely different understandings of how the stock market works.
Exactly. And it's not just about remembering those times. It's about how those memories actually rewire our brains. So that person who came of age during a stagnant market, they might be really cautious with investments, even if the economy is doing great. Their brain is stuck in this survival mode,
Yeah.
even if it's not logically necessary.
That's so true. It's not just broad economic trends either. Think about someone who lived through the crazy inflation of the 1960s. I mean, they're going to view money completely differently than someone who grew up during the stable prices of the 90s. I know my grandparents, they lived through the Depression, and they were so frugal, their entire lives.
It's fascinating, right? These money memories become our default settings. And studies actually show that people often invest based on the market conditions they saw early in their life, not a logic.
So it's almost like we're all carrying around this financial baggage from our past experiences.
Yeah, and it shows how two people who are both smart can have totally different views on money just because their experiences were so different.
Even Bill Gross, who is this renowned bond investor, he says his success was partly just being in the right place at the right time. The bond market boomed during his career. Can you imagine if he had started a decade earlier or later?
Yeah, his whole perspective might have been totally different.
It kind of makes you think, how much of what we consider financial success is skill versus just pure luck?
It's a great point, and it leads us to this interesting concept that the author talks about, the lottery paradox. He talks about how people who buy lottery tickets, even though the odds are so slim, for them, that dream of wealth is worth the financial risk.
I mean, isn't there a bit of entertainment spending there? They're not only looking at hitting the jackpot, it's also about that weekly dream of what if.
Right, but what's interesting here is perspective, right? What seems like a reckless gamble to someone with more financial security could be like a glimmer of hope to someone who's really struggling. To them, that lottery ticket might be their only shot at a life they couldn't have otherwise.
Yeah, that makes sense. It's not that they're ignoring the odds, it's just that the potential reward is so huge that it feels worth the risk. Like the author says, and I love this line, he says, "We are paying for a dream." And you may not understand that because you are already living a dream.
Exactly. Their reality is so different, and to judge their financial choices without understanding their circumstances is not only unfair, but it misses the point of the complex factors that are at play.
And that all leads back to the author's central point, right? No one's crazy, just different. What might seem wild to one person makes perfect sense to another because of their experiences. And he uses this really great example in the book from the New York Times about Foxconn.
Oh, you mean the story where a worker's nephew defended the conditions? Like he said, for his aunt, working there was a step up from a life of prostitution.
Yeah, exactly. It really shows how different experiences can lead to completely different views on the same situation.
It's a reminder that we need to approach these things with some empathy.
Absolutely. What might seem crazy to us might be perfectly rational to someone else. It's like we're all navigating this maze, but we all started in different spots and we all hit different obstacles along the way, so it's no wonder our paths look different.
And on that note, let's talk about how new some of these financial systems we use actually are. We might think we have it all figured out, but we're essentially all newbies when you think about things like retirement planning, college funds, even consumer debt.
I mean, the author uses this great analogy about how dogs have been domesticated for 10,000 years, and still retain some of their wild instincts. And we're over here with a couple of decades of experience with this modern financial system, expecting to be total experts.
It's true. These concepts just haven't been around long enough for us to have generations of wisdom about how to really manage them well.
Yeah. Take retirement, for instance. It's this huge industry now with trillions of dollars in retirement accounts. But this whole idea of retiring comfortably is a relatively new concept, right?
Right. For most of human history, people worked until they literally couldn't work anymore. Retirement just wasn't an expectation or even a financial reality for the vast majority of people.
So when did that change? When did things start to shift?
Well, it started gaining traction in the 20th century, with the introduction of Social Security here in the United States. But even Social Security, it wasn't always the safety net that it is today. The first Social Security check that was issued in 1940 was for a whopping $22.54.
Wow, that's barely enough for a week's worth of groceries these days.
Exactly. And even private pensions, which some people look back on as this golden age of retirement, they were never as widespread as we might think.
So this idea of everyone being able to retire comfortably is actually pretty new.
Very new. And along with that came the expectation that everyone would save and invest for themselves. The 401k, which is a huge part of retirement saving now, wasn't created until 1978. And the Roth IRA, another popular retirement tool, came even later, 1998.
That's crazy when you really stop to think about it. We're all kind of just making this up as we go along, which kind of explains why there's so much anxiety around retirement planning. It's we're all playing a game where the rules are constantly changing.
It's not just retirement either. Index funds, hedge funds.
Oh, can we pause for a sec? I think we should define those terms because some people might not be familiar with them.
Oh, yeah, of course. So index funds are basically baskets of stocks that track a specific market, like the S&P 500. It's a way to diversify your investments without having to pick individual stocks. Hedge funds, on the other hand, are these actively managed investment funds that use more complex strategies to try to get really high returns.
So both are ways to invest, but with different levels of risk and involvement. Okay, got it. So you're saying.
Right. Even these are fairly recent innovations, just widespread consumer debt. So given this constantly evolving financial world that we live in, how do we start making better money decisions? That's the million-dollar question, right?
It really is. I mean, where do we even begin? Acknowledging the role that our personal experiences play is a good first step, right?
It's essential. We have to start to become aware of our knee-jerk reactions, those ones that are more about our past than about actual sound financial reasoning, recognizing our biases.
So it's hitting that pause button before we make a big financial decision and asking ourselves, is this just my fear talking, or am I making a calculated risk here?
Exactly. And once we know what our biases are, we can start to challenge them. That might mean educating ourselves, getting different perspectives, or maybe even talking to a financial advisor who can offer a more objective viewpoint.
It's almost like we have to become financial detectives, investigating our money stories, and searching for clues that might be leading us astray.
The author actually suggests that we should pay attention to the narratives that we tell ourselves about money. What stories do we tell ourselves about wealth, poverty, risk, reward, all of that? Where did those stories come from? And how might they be shaping our choices today?
It's we need to become more aware of the soundtrack that plays in our heads when it comes to money. Are we constantly playing those same old tapes of scarcity and fear? Or are we ready to write a new financial anthem that's more aligned with our values and goals?
That's a great way to put it. The author talks about reframing our mindset with money, shifting our focus from what we don't have to what we do have and what we can control instead of what we can't.
I love that. Instead of focusing on scarcity, we shift to a mindset of abundance. And instead of dwelling on what we can't control, we focus on what we can. It's gratitude over resentment. It's taking the power back from those old money scripts.
Precisely. Another key takeaway here is long-term thinking. Real financial success isn't about getting rich quick or chasing the latest investment trend. It's about building a strong foundation that's based on smart principles and habits that you can maintain over time.
It's a marathon, not a sprint, so we got to pace ourselves, be patient, and trust the process.
And that process includes making smart choices, managing risk effectively, and not getting caught up in the emotions of the market. It's about playing the long game, knowing that slow and steady wins the race.
All right, which brings us to the inevitable ups and downs that come with investing.
Yeah.
How do we navigate those without totally freaking out?
The author is a big believer in having a plan, sticking to it, and not letting those short-term changes mess up your long-term goals.
Don't panic and sell everything when the market dips. Got it. What else?
Diversification is really important too. You want to spread your risk across different types of investments. You don't want all your eggs in one basket, right?
Yeah.
So build a portfolio that can handle those ups and downs and come out stronger.
This is all great advice, especially with how volatile the market has been lately. It's so easy to get caught up in the hype and make a decision based on fear or greed.
True financial security is about making informed choices, staying disciplined, and keeping your eye on the big picture.
And that big picture includes not just our financial well-being, but our overall well-being, right? It's not just about the numbers. It's about how money fits into our lives.
Absolutely. The author really emphasizes aligning our choices about money with our values. We should use our money to create a life that feels fulfilling and financially secure.
It's not about just accumulating wealth. It's about using wealth to live a meaningful life, like finding that balance point between financial security and personal fulfillment.
And that intersection looks different for everyone. There's no right way to manage money. The key is figuring out what works best for you based on your circumstances, goals, and values.
Okay, so we've talked about how our past kind of shapes our relationship with money and how that can lead to some maybe not so great biases. But how do we use this knowledge to actually make better decisions? Like how do we actually break free from those old patterns and create a financial future that we actually want?
Well, the author suggests starting by defining what success actually means to you. What does financial security look like? What are your goals? What are your aspirations?
Yeah, it's about getting clear on what we want, because it's so easy to get caught up in comparison, right? Like comparing ourselves to others or chasing some arbitrary definition of success that we see out in the world. Our financial journey should be tailored to our own values.
Right. Exactly. Your financial plan should be a reflection of who you are and what you want, not what society or social media or whoever tells you you should want.
So much of the financial advice out there is just so generic.
That's why it's so important to personalize your approach to money. And once you have that clarity about your goals, you can start focusing on what you can actually control. You can't predict what the market's going to do. You can't control interest rates, but you can control your spending habits, how much you save, and how much risk you're willing to take.
That makes sense.
Yeah.
It's like shifting our mindset from feeling helpless to feeling empowered. It's not letting those external forces determine our financial well-being. It's like recognizing that we have more agency than we think we do.
Exactly. And true wealth isn't just about money. It's about having time, freedom, and the ability to do what you're passionate about.
That's such a good point. Money is a tool to create the life that we want, but it shouldn't be the thing that controls our lives. It's a means to an end, not the end in itself.
Exactly. And for some people, that might mean early retirement. For others, it might be starting a business or traveling the world. Whatever it is, the key is to figure out what matters to you and make choices with your money that support that vision.
So as we wrap up this deep dive into the psychology of money part 2, what's the one thing you really want our listeners to take away from this?
Well, I think the biggest takeaway is that we're all products of our experiences, and those experiences really affect how we think about and manage money. But the good news is, by understanding those influences, challenging those biases, and figuring out what success means for us, we can break free from those old patterns and create a financial future that is both prosperous and truly fulfilling.
I love that. It's not about blaming our past for our financial situation. It's about understanding how those experiences have shaped us and then using that knowledge to make more intentional choices moving forward.
Yeah, it's about taking control of our financial journey and creating a future that really reflects our values and dreams.
Well, we covered a lot today, from the influence of our early experiences to the importance of thinking long-term and making sure our choices about money align with our values.
As you go about your day, I'd encourage you to think about the experiences that have shaped your own view of money. How have they influenced you? And what can you do today to make sure those financial decisions are really in line with what you want for your life?
That is a great question to think about. And remember, no one's crazy when it comes to money. We're all just navigating this crazy, complex world the best we can. But with a little self-awareness, some introspection, and a lot of intention, we can all rewrite our money stories and create a financial future that is truly fulfilling. Thanks for joining us on this deep dive.